Hey, welcome to another episode of Financial Theory. Let's talk today about the stock market, but this episode is going to be for beginners. So rather than bore you with the basics of the stock market, I'm just going to go through what I personally feel are some of the most important fundamental points about the stock market for beginners and how these points can actually help turn you into a better investor and help make you money. So when the business makes money, you make money. If the business struggles and it loses money, you lose money. So that's the first thing you got to understand. It's just not a random number on your screen. When you buy a stock, a share, you become a part business owner. So you need to understand that. The second tip is to build an emergency fund first. Don't touch this money. This money is designed to protect you in case your stocks crash. This emergency fund will keep you afloat in the meantime and will help you live for the next few months until your stocks recover, because essentially you don't want to be selling your stocks at a loss because you've run out of money. So that's why having an emergency fund, 6 months of living expenses saved up first, that's extremely important. You need to be prepared before you actually go into the stock market. So you have to understand that you should only invest capital that you can afford to leave untouched for the next 5-10 years. That's vital. Tip number 3 is to invest in an ETF or an index fund. When you buy an ETF, you are buying the whole US economy. So what this means is, let's say if you buy a share of an ETF that tracks the S&P 500, this means is that you're buying into the top 500 companies in the United States of America. So by doing it this way, it's a lot safer than buying individual stocks because you're investing in the whole US economy, and the US economy will always be growing every single year. The S&P 500 grows on average about 10% each year. That's how much your money would be growing on average. Personally, I would suggest an ETF like VOO, VOO. The reason why I like VOO is because it's run by a respectable company, Vanguard, but also VOO has a very low expense ratio of 0.03%. So what this means is if you invest $10,000, you only have to pay $3 each year in fees. So what I like to recommend to all beginners is to put, let's say, $200, $300 each week into buying more shares of VOO, VOO, and you do that every single week. Let's say if the market crashes, that's when you would double down and you would buy double or triple the amount if the stock really crashes. And by doing this technique, it also helps lower your buying average of your stock. When the stock drops, that's your opportunity to make money. You got to remember that, right? So tip number 4 is to understand the stock that you are buying, understand the business behind it. If you understand how the business works, how the business makes money, the risks that come with the business, its competitors, its current sector landscape. If you have a solid understanding of the business, the stock that you are buying, you will have high conviction. This is so important. That's why people who freak out and panic sell, these are people who do not understand what they purchased. So when your stock crashes, when you have a solid understanding of how your stock works, the business, how it works, you will not panic sell. And these moments are critical. So it's in these moments that will decide if your portfolio breaks or survives. So I would suggest to all beginners to start buying ETFs because that's a far safer way of making money. Keep buying every single week, and over the long term, your ETF stock will keep going up. So only buy individual stocks once you actually have a solid understanding of the fundamentals of how the stock market works and how each stock works. You need to understand how to valuate a stock using metrics like the PE ratio, the PEG ratio, the PB ratio, the ROE, return on equity, net profit, free cash flow, EPS, earnings per share, debt to equity ratio. There's a million of these metrics that you need to understand before you can actually evaluate a stock. And understanding how to do this will really help you make better financial decisions before buying a stock so that you won't get ripped off. Tip number 6 is to diversify your portfolio with about 5 to 10 stocks. I think that's plenty of diversification. If you over diversify your portfolio, you will get pretty average results. Try to pick stocks from different sectors as well. So let's say, for example, if tech stocks are crashing at the moment, and if you have other stocks in other sectors, that will help stabilize your portfolio. For example, if you have other stocks in healthcare or utilities, it can help stabilize your portfolio while the tech stocks are taking a hit. And also, if you have a concentrated portfolio, you can win big if you select the right stock, but also you can lose big if you select the wrong stock. That's the trade-off between having a diversified portfolio versus a concentrated portfolio. Just keep that in mind. If you select stocks that have solid fundamentals, if the business is making very good profit margins, making a lot of revenue, they're growing significantly every single year, these are things that you want to be looking at. If they have low debt, these are the sort of things you should be looking at when you want to buy into a business. The fundamentals are the main thing. And also, before you buy into a business, look for businesses with an unbeatable moat. Let's say, for example, Google has a very unfair advantage in its reach in Google search and in media. It's very hard for any other company to come and beat YouTube at its own game. Many have tried, many have failed. And that's what I mean by a moat, having an unfair competitive advantage that protects its business from competitors. This is how you're going to lose a lot of money if you try to copy other people and follow random YouTubers advice without doing any research of your own. That's how you usually lose money. Because a stock is going up, like for example Micron has been, doesn't mean you should be buying at the moment right at the top. What happens if tomorrow if Micron stock starts crashing down again? So never FOMO into buying a stock. These are very risky ways of making money in the stock market. Day trading is gambling to me, so I'd stay clear of that sort of behavior because it can get addictive, and before you know it, you've lost your entire life savings. You've been warned. Avoid day trading and stop looking for quick wins. Warren Buffett has said many times that the best way of building wealth is by building wealth slowly. I know a lot of people just want quick wins, quick money, but that's a really easy way to actually lose your life savings. And also avoid options trading. This is not something you want to be messing with, especially if you are a beginner. Options trading is very risky, so if you don't know what you're doing, just stay clear of it, okay? For most new beginners, they fear volatility and they look at it as a bad thing. But for more experienced investors, we know that volatility is actually where the money is. Volatility is when we have a chance to actually make money. So let me explain it this way. If you're new to the stock market, you'll see volatility. Oh no, it's a bad thing. My stocks are going down. But for more experienced investors, we see volatility as an opportunity. So when stocks crash, when the stock market crashes, this is our chance to buy high quality stocks at a 30-50% discount. If you go into, let's say, Harvey Norman or any sort of store, and if there's a 50% discount on the item that you want, would you not buy it? So the stock market's the same thing. When the stocks are crashing, this is our opportunity to buy quality businesses on sale. And then we hold those stocks, and then when the price goes back up again, that's when the real money is made. So volatility is your friend, it's not your enemy. Tip number 10 is to avoid selling your stocks too often, to avoid paying too much tax. Now, this is something that a lot of beginners don't actually consider because they're new and they don't know any better. But the better strategy is to actually hold your stocks long term, and then you can sell it after 5, 10 years, 20 years, and that way you pay far less tax than someone who's constantly selling their stocks, constantly every single day or every single week. Imagine how much tax you're going to have to pay to the government. So you have to take into consideration the effects of tax as well. Every time you sell your stocks, you're essentially paying the government a big share of your winnings. And also the other advice I would give is to pick a brokerage platform that has the lowest fees possible. So me, I personally use Moomoo, and I think it's a really terrific platform. This video is not sponsored or anything, it's just my personal opinion. I've tried a couple of other platforms like CMC Invest, not very impressed with them. So I think Moomoo is the far better option, but there's heaps of other options if you want to do your own research research and then pick the platform that seems the best for you and has the lowest brokerage fees possible. And I also wanted to mention that in each different country, the tax rules will be different. So you should do your own research regarding the tax rules in your own country. So that's really important as well. So tip number 11 is to have a long-term vision. So this is my approach. I'm not touching the money in my stock account for the next 10, 20, 30 years. When you do that, it actually gives your money a chance to compound. Compounding only works if you keep adding to it and you don't withdraw it out. So think of investing as planting a tree. You don't go to the backyard digging the roots out every single day to see if the roots are growing. Investing is exactly the same thing. You don't go digging into your account every single day, withdrawing money out of it. How can the money grow? It's the same with the tree analogy. You have to keep adding onto it and let it grow. Time is a very powerful factor for compounding. And if you're holding stocks long term for the next 10 to 20, 30 years, the in-betweens, ups and downs for the next few months, these are irrelevant and just media noise. So you have to learn to ignore the noise. So if you've got individual stocks, you need to keep up to date with what the companies are doing, what's happening with the business, because it's going to affect your stocks and your portfolio. All right, I hope you guys got something useful out of this. So those are my top tips for beginners to get started in the stock market and to actually make money in the stock market. If I missed anything, please let me know in the comments. If you enjoyed this video, give this video a thumbs up, like, comment, share. I will catch you guys in the next video. See ya.